Brilliant. Well, look, thank you everyone for joining us. Delighted you're here. We're delighted to be here, and we're going to talk about funding for later stage companies. So my name is Naveen. I'm your moderator. I am COO and co-founder of a co-working and construction technology business called WorkWise, based in San Francisco. And before that, I was in private equity for 10 years, funding later stage companies. So I'm going to pass you on. We're going to go down the line here, starting with Vincent at the end, and they'll introduce themselves.
Vince Montevart, Principal at Global Capital Markets. We're a middle market M&A transaction firm. I specialize in the software, transportation logistics, and high-tech manufacturing for the middle market. Prior to that, I had my own number of different software businesses, so getting late-stage funding was a very key aspect in my role as an operator. So I come at it from both from an operator and an investor standpoint.
Hello, good afternoon, everyone. I hope everyone's feeling really great this afternoon. My name is Murad Wahab. I'm a founder and principal of Hakim Saya, and we are your global funding partner. My background is actually in banking and finance, working for top-tier financial institutions in the US, like Wells Fargo, JP Morgan, City National Bank, which was acquired by RBC. And then I've also been in hospitality industry here and abroad over 13 years. So this topic is very close to heart about, funding for the later stage companies. So I'm very excited, and thank you for the host and everyone to putting my panelists to be here and to share that our knowledge and wisdom with you guys. Thank you.
Hello everyone, Alice Zhang from the Bob Xu family office. I graduated from Berkeley 13 years ago, and then I was back to China doing startups, early investment, later stage investment, and right now I'm back to the Bay Area, and my focus is in Web3 right now, but as a family office, we're still looking to some different industries. So very glad to be here, and thank you for the inviting.
Wonderful. Right, so let's get into it. So the four of us have spent hours of our lives looking at funding contracts, and like any good funding contract, you should start with the definitions. So I'm going to come to you, Alice. When does an early stage company become a later stage company?
For me, I think that's a question not really about the letter names, because we all know that we have angel investment series A, B, C, D, E, F, G, whatever. But I noticed some phenomenon. Sometimes we have A plus round, right? And I think I once saw A plus round. Yeah, so that's really not the letters matters. Starting from B, you are later stage. I think it's really about the ability and the quality of a company. Maybe it's not a perfect, example, but it's just like for baby, you are not expected to be eating by themselves or maybe even not potty trained. But of course, for a middle school student, you need to go to the toilet by yourself, right? So that's just the difference. I think when the company goes to a later stage, it's not about the founding team, the storytelling, or like MVP, not that things that much. It's starting talking about CAC, the LTV, and the revenues and the numbers. So it's transferring from people storytelling to people plus many numbers that are pretty much focused on the financial metrics. So everything got lifted up all around, from product, market, operating, and also like revenue model, and of course funding, because you are facing to totally different investors, and they are expecting totally different preparation answers and the situation about the company. So yeah, if you're really talking about the definition, maybe starting from B round, but I think it's always important for everyone when talking about that topic, really looking into the company, what's the real stage that you are in, because I think for a company, every decision is like at least 6 months cost, timely or money wisely. So when you make the decision you're going to raise a later stage round, then maybe it's better to see whether we're really in that stage. Even you still have an A+++. I mean, that may still work, but the really thing that matters is the real status.
Murat, I'd really like to get your perspective on this, given how much time you spend funding later stage companies. And I guess what I want to know is, what do you look for in a company? And also, do you ask the founders if they are potty trained whenever you, whenever you see them?
Thank you, Naveen, for that question. So for us at Hakim Saya, when we work with various funders and lenders, and mostly in the private family offices, when we look at companies that we want to fund or we want to lend to, that there are various criteria or characteristics what we're looking at it. So the definitions, like Alice piggyback, that very defined. So when we look at it, sometimes on the loan side of it, like how much to request it, like must be beyond like Series B. So like 10 million, 50 million, 100 million, right? To have Series B, C, D, E, whatever you name it. So when we look at, not only we look at the team as per se, but we look at the company, whether they are profitable. Sometimes they are not profitable, but also the revenue side. So we will look at, sorry? Yeah. Okay.
I was going to say, does a later stage company need to be profitable or need to be able to demonstrate a clear path to profitability?
Yeah, so in my world, yes, we want to look at there is a path to profitability and how long it's going to take. So we look at your 5 to 10 years financial projections to look at it and where you're heading. And then even at the break-even point, we need to see that how you're going to reach that level. So there are, as I said, variations of criteria we're looking at it. I can talk on this topic for non-stop, but in general, you got the idea that you've got to be something that to show that there is a path to profitability.
Thank you. So moving on then, we'll move to the next stage of the fundraising. And in my experience of fundraising, the old adage, fail to prepare, prepare to fail, has never been so true. So Vincent, coming to you, what work do later stage companies need to put in advance of going to the market for funding? And I think what would be interesting from most of the panelists, I'm going to come to most of you here, is to understand the difference between earlier stage, because I think people are very familiar with early stage funding. And the contrast between later stage funding rounds is quite stark, and the requirements are quite different. So Vincent, I'd love to get your perspective on that.
When companies approach me and I can see that they're getting towards a late stage round, the first thing I'll tell them, I'll congratulate them. Getting from the early stages to the later stages, as we all know, it's not easy, and in today's environment, it gets a lot harder because of the funding. So I always look at, all right, what have you put in place? I can just give you a little bit of a story. I was working with a very early stage company as an advisor in San Diego, and the CFO came out of it was the first CFO, and she came out of a large consulting group, and it was her first startup. She's looking at the finances, and she's looking at me. She goes, when do we start thinking about profitability? And I said, now. And she looked, and she goes, there's just no way. Just because of the stage we're in. I said, no, you need to start thinking about profitability in areas of the business where you want to scale it. You need to start thinking about that now, because when you get to that later stage, you're already able to show a new round of investors, more sophisticated investors, that you have command of the business. You have command of the financials. You have command of where you're at in the marketplace, where you need to grow, and how are you going to maneuver that P&L to grow that business with this new funding round. The level of sophistication of the late stage investors are somewhat different. They ask more questions about the management team. Have you done it before? And it's not to say that a founder, cannot make that progression. But going from a $15 million company to a $50 million company is a lot different than going from a $5 to a $10 million company. So there's a lot more things that go into that in terms of your people, in terms of your metrics, how you run your business, how you course correct from those metrics, and how you learn from them. Please, you need to give those examples when you're going through the process. But also, too, like you looked at when you're early stage investors, these late stage investors is going to be another marriage for you. And so being able to work with them and talk their talk and be able to show them that you'll be a good steward of their capital is very important.
And Alice, I mean, like, from the entrepreneur's perspective, so running a business is hard enough, and then you have to raise money, so that's another job you have to do. But when it comes to the later stage, the requirements, you know, the amount of information you have to produce, the quality of the information you have to produce, the historical information that you have to be able to verify that's accurate. There's a lot of work involved. How do you manage that whilst you're running it? What are you looking for in terms of the founders? What kind of awareness or strengths are you looking for in terms of founders to give you the confidence they can manage that process and deliver the funding?
I think first maybe we still need to get back to the attitude because sometimes the founders also may blame on some other factors, you know. But I mean, if as a founder first, you really need to realize that you're getting to a totally different stage. And before that, like Nevin said, we need to get prepared. So that preparation, I think first we need to start from people. Because usually, I think the founding team may not be the same team when you get to the later stage. Sometimes it's hard to face, but I think it's very realistic because it just requires different kind of qualities. So because when you bring your team to the investors, they will also notice and feel like whether this team is the right team for the future scaling and growth. So maybe really need to start with the self. You need to get very well prepared, and then starting from your founding team. If really there's someone you need to get into the team to be more professionally, manager or something, you need to do that and replace someone that may not be appropriate. And then it's really like what we talked about just now, the numbers. Like how is the potential for the growth? Even you are not profitable now, but what's the potential path that can we show to the investors, like the market acquisition and the revenue growth? So all those things need to from a good track record, or at least we need to do a much more detailed forecasting. It's not that from the angel round, you may do the forecast just randomly. And from the later stage, it's very important to do that.
So no more hockey sticks. I mean, Murat, your approach for funding from lots of different types of businesses, and I guess lots of different types of entrepreneurs, many of them who've built these businesses from the start, right? What are typical mistakes that founders make when transitioning, when managing the transition from raising early stage money to later stage capital?
That's such an excellent question. And I think that is worth noting is that apart from what you hear from other panelists regarding the management team, they emphasize that a lot, right? Because what makes you like your current team at this stage, at the later stage, is the best team to execute that. So there are other things. For example, that there are examples that I can give you, or a company that we're looking at, that we've been advising them from 2 people to, and then they grow to 20, then they grow to 100 employees. And their annual sales revenue that grows rapidly from $5 million revenue and then right up to 20, 50 and all that. So in the interim, what we do is actually, personally, I would advise them in a very consultative approach to look at how now they're already at the later stage. It's a different ball game. So if you want to play with the big boys, you've got to actually be part of those leagues. This league is not easy. like Vincent said, this is more sophisticated investors, more sophisticated lenders. You have more things to prove. For example, your financial, it has to be flawless. Business tax returns, reviewed financial are not cut. It's not cut it. You need to have perhaps an audited financial, which is that we always emphasize on the quality of your financial, because there are other things that we need to consider before actually the investors, because investors and funders need to protect themselves. So, from losses, how to mitigate that risk. So you as a founders that at this later stage have to think about financial. Profitability is one of them. Financial ratios, liquidity ratios, some of those like your operational, covenants, your financial covenants, everything will be put in place. That is very important that we look at it, because each of companies and industries are very different. For example, that I have worked with the companies that, one of the owners is actually Mark Cuban. And so, I told the CFO and the owner of the business, you got to work from now. You don't wait, because they say, well, I will spend a lot of money to pay. You need to invest. You need to invest, because those are expenses that you can get it back. It's a tax deductible anyway. But funders and lenders want to see really a quality reporting. What had happened if they were not following that our advice? They were not to get the acquisition where they acquire another company and in the position without having to borrow or raise more money. Because it's important, you are in a better position when you don't have to get money or raise money that way, because you have your own capital. But if you're not in that position, you better get ready to get all of these in order. Okay? So I hope that will provide some insight.
No, I thought that was really interesting, and also beautifully segued into my next question, which is, one of the great things about being a later stage company, if all of a sudden you have many more options for funding, right? It's not just, an angel round from Uncle Bob and a few friends. It's not just pre-seed, seed. It's not just straight equity. You all of a sudden have this smorgasbord to look at, but that can be difficult. It can be difficult to fully understand each instrument, what it means for you, what it means in this scenario, in that scenario, and how onerous the demands are. And I guess I'm coming to you, Vincent, on this one. How do you advise and help companies? And this isn't a simple answer, I know it isn't, but how do you advise and help companies on what mix how they should kind of comprise their funding packages? What kind of mix of debt, equity, alternative financing like Murat, and I'll come to you after Vincent. How do you kind of go about that process?
Well, I think it really, it's a good question. What it really, way I look at it is, what is your go forward strategy? What is that forward looking strategy? What is that your revenue profile look like? Because you'll have possibly some big banks, you'll have some possibly some hedge funds, you might have a strategic, maybe some of your customers want to come in some of the later rounds. And so now you got everyone that's coming at, putting term sheets or offering you capital. And it's a mixture. Some could be all equity, some could be a mixture of debt and equity, others could be just equity. And not really caring about the valuation. Generally, the strategics are in that class. But it's really it becomes now, all right, where is the best route forward on who's going to lead? So you have across a number of different groups. But now, who would you like to lead? And you have to take a look at it. Like I said earlier, is where is that revenue profile, and who's going to help you get that revenue profile? It might be a strategic. Might be one of your customers that's going to help you out in the marketplace. And that customer and that strategic may be that you're acquirer in the next round. All right. Or if you're still trying to capture more market share, all right, so maybe it's more equity. And you look at some of the bigger VCs or maybe some of the bigger private equity, they're going to give you some equity, going to give you money through equity and also help you fund some future acquisitions. So I think it comes down to the strategic go-forward plan for the business and how that translates into who is that best lead investor. Those others that are on the table, they still could come around. They still can come along. They just won't be in the lead. They won't be able to set the terms. But if they're there at the table with you at the beginning, they're going to want to participate in the investment.
Murat, I mean, you touched on this slightly earlier, but more choices of funding options means more strings. And often, earlier stage companies aren't used to dealing with those strings. So you just talked about debt covenants and things like that.
Right.
How do you ensure that they can handle that level of intensity that goes into managing things like covenants and, the investor relations required to manage, debt providers, which is totally different to managing equity providers?
Absolutely.
So how do you gain confidence that they can do that? How do you know that that's not going to be an issue for you in 2 months when they're not providing you what you need or so on and so forth?
This is another excellent question. So I want to share that with the audience is that, when you come to this stage, the company at the later stage, also what happens is that your financing needs to become more complex, right? More complex, and it's very consequential so that you actually choose not just the capital, a raising capital is the right capital. There are different ways to do this. One of the ways to do is leverage of your assets that you have. One of them is whether it's asset using your account receivable or using your inventory, your commercial real estate, intellectual properties, your equipment financing, that have. Because by doing this type or leveraging this type of asset, you don't have to dilute your equity stake of your company, if that is that stage that you're comfortable with, right? So as the lenders and the funders to fund these types of financing is that we work with the client or even the lenders. What they wanted to see is that the borrower must have to put in place some of restrictions, or I would say the covenants in place to mitigate the risk. To mitigate that risk. And what does it look like? So mostly that you will find that either investors or funders are going to put in place either like, for example, if they use a debt, maybe it's a non-recourse. So non-recourse, but certain funders will say that non-recourse but with a bad boy cover. What does that mean? So that means is that you're not personally liable, but with a bad boy carve-out, you can actually be liable for something like, for example, if the lender put a covenant, for example, like I would say financial covenants, which is that you are intentionally misled, misrepresenting your numbers, your companies, so that they're going to hold you liable for that. So the covenants is very important for any lenders and funders that to do their legal due diligence, to making sure that founders are followed accordingly, that not only to protect the investors of the funders, but also at the same time the borrowers. Because without these covenants, such as like, for example, they put like you have to have a $1 of profitable. So that means is that you cannot have a negative covenant. Your business cannot have a negative because you're running losses. That means that you are in violations of your covenant. So there are a lot of things that funders put in place to mitigate the risk, because bottom line is that any funders and investors, what they're looking is that to safeguard and protect their interests, right? So this is some of only, I would say in general, that you hear from what I said, different covenants and different restrictions or oversights that mostly that the funders are put in place.
Alice, I want to ask you a question. So, as a family office investor, you'll often be in situations where you've invested in an earlier round. The company has thankfully got to a place where it can now raise later stage funding. How involved are you as an investor in the business in helping management and the rest of the people involved select that lead investor that Vincent said is so important?
Yeah, I mean, because for family offices, there are different styles. But for us, because we're coming from the tech investment, so yes, we do invest in early stage, and then it will take a lot of energy and effort going with the company to the later stage because, like I said just now, the team, from that point of view, we will start helping them. Sometimes we need to recommend, better people or like appropriate people. And then for the investors, that's the same because especially the leading investors, it may determine the direction of your the future funding and sometimes your strategy making because different people have different appetite. So we will, also recommend related investors, but I think it's also important to talking with the founding team seriously about exits. Because that's some topic that you seldom maybe mention at the very beginning because that's just kind of joke, right? Not started yet, not proven yet. But when we're talking about the exit, you need to get a little sense of what's the potential direction, like M&A or IPO, that's totally different actually. So maybe starting from there and we will make more clear strategy together and then we will bring them to different funds to get more exposed.
Yeah, so actually you're very heavily involved.
Very heavily involved, that's true.
Now, I think we have time for one last question, which I'd like you all to answer. And that is, to help the audience understand what are the prospects for funding for later stage companies. So we're now in a place where we have, higher interest rates. Murat's charging a lot more for his financing than he was previously. Tighter liquidity. A looming election. Roaring Kitty is back. Dominating the stock market. So there's a lot of volatility out there, and so I'll start with you, Vincent, if you don't mind. Just understand the prospects for funding for later stage companies, and is there anything in what I've just said, particularly Roaring Kitty, that will impact access to capital?
Well, I think all of that has an impact, no matter where you're at in your funding round. And when I talk to groups, they ask me that question. Well, how hard is it out there? You're out there all the time. I said, well, yeah, it is, but the quality deals are still getting done. And they're getting done at a very good valuation. So a lot of what we talked about here on the panel and how you get ready and all that. So yeah, that is part of it. How you execute it, that's part of it too. You might be, there's not many quality deals out there right now, but the ones that are get a lot of attention. So as you go through the process, as you grow in your business, and you have your early stage investors, and you have your board of directors, you start leaning on them to start helping you figure out where that lead investor, or maybe they're that lead investor, that is going to help you get to that next stage. But doing the homework and being prepared, as I think we all talked about here, it pays off when you're in times of markets like it is today.
I'll piggyback what Vincent said, so I'm going to add into that as well. So what I want to emphasize is to the audience is that it's not just about raising capital. You need to understand what is the right capital for your companies at that stage, because it has to align with your overall objective of your companies and where you at that point of time to accomplish. Also, it's very important for you to think about the right lending partner, the right investors for your company at that stage. As Vincent said, deals get it done, even with the tougher market environments that we're in, even with the highest interest rate. And people always come to me and say, your family office's interest rate is very high. But think about this, Federal Reserve have not actually cut down the interest rate. So if you compare if you just go by prime rate right now, so 8.5, and then if the bank are going to charge you a financial spread like 1%, 2%, even at 2%, if the 8.5 plus 2, you're already at 10.5%. So our family office normally would charge around 12%, 13%. It's not far off, but a good deal for you, like Vincent said, you need to basically to prepare yourself. Get that. the right group and everything. So that is my advice to you to get ready because you are playing in the different league now. Thank you.
Yeah, make it short. I think just be strong regardless of the environment because many very great companies they started in a time that is not that easy, not too many bubbles, not everyone is fundraising, but they still stick on. And so I think even it looks hard work, but it still have someone like Vincent said, they're successful. Yeah, so.
Brilliant. Well, look, thank you, panel. The panel have generously, because we don't have time for questions, agreed to stay around afterwards, and you can ask them what they want, and you can buy them a drink, and all that kind of stuff. But I'd just like to say thank you to Alice, Murat, and Vincent for their wonderful contribution. I'd like to thank all of you for being here, and I hope you enjoy the rest of the day. Thank you.